Dear subscribers, as you know, we shared many information for you, and we are studying very hard to find current news for you. However, I cannot use this channel for future. Please follow our new channel called as Daily News Report and watch our video to support us. Link in description. Also, you can reach the video we shared on Daily News Report by clicking on the top right button. We highly recommend watching, subscribing, and sharing. We will continue to share some news on this channel where we take precautions against some situations for future. Thank you for supporting us.
Letter. Dr. Willie, how are you doing today?
I'm doing fine, and the hat-trick letter is found on goldenjackass.com. That's the website. Been in business now for 12 and a half years. Got a load of subscribers, a lot of clients, but fortunately I've also got, Mike, a nice group of colleagues, and we're kind of a bunch of equals. We're a group of equals, and the hat-trick letter has been supported in the last 4 or 5 years by pretty heavy-duty analytic contributions that work toward the forecasts for the hat-trick letter. And I invite people to go to the goldenjackass.com and check it out. There's some free material in there, and this interview will be posted on it. So it's been a labor of love, Mike. It's been a lot of work. I've got quite a lot. I mean, like 30 or something, 30-something correct forecasts, whereas most Wall Street analysts are paid probably close to $500,000 to be consistently wrong.
That they certainly are. Any particular insight or opinion as to why you think that they may be wrong so often? Do you think it has anything to do with their corporate sponsorship and trying to please them? I mean, if anybody told the truth on a regular basis, that would certainly probably turn viewers away, which would affect advertising dollars. That's just my amateur guess, but...
Well, all Wall Street banks force their economists to toe the line. So their whole line is support the dollar, support the bonds, lie about the economy, say everything's fine in order to attract more investment into stocks and bonds. It's really that simple. And if you look at the Wall Street Journal, you see a lot of advertising revenue from mutual funds, other minor banks, and various other financial firms. So they're all in the same boat together, and they're selling stocks and bonds. They're selling dollar-denominated assets, and they don't want you to think that the recession is horrible and vicious and going to be ongoing, because you might pull your money out of Wall Street, pull it out of the stock market, pull it out of the bond market. They're paid to follow a corporate narrative. They're paid to follow a business plan. They're not paid to be correct.
Absolutely. So that they're constantly pushing an agenda as opposed to pushing information regardless of who it benefits. And you know, that's to be expected, I suppose, from the mainstream media, that or as well as the major banks on Wall Street, which kind of leads into my first question. What I did was, knowing that you were going to be a guest, I had asked people to submit questions, and I got probably several hundred total. And I tried my best to condense them down into questions that would best answer the common, everyday, average person's questions about why they should believe that there's a crash coming. And the first one deals with something that you just mentioned. So I'd like to ask you, there certainly seems to be a contradiction out there about whether the dollar is going to be collapsing or whether it's going to be saved. And part of that has to do with the fact that the very same people that continue to keep the petrodollar alive, whether it's through derivatives by opening up lawsuits against like Saudi Arabia. We've got interest rates that have been all kept near zero for virtually the entire duration of the Obama presidency. Those are all things that are ultimately destroying the dollar. Yet on the flip side, we've got this seeming effort to maintain it as the world's reserve currency, largely, I would say, through the use of our military. What say you on that?
I don't think current policy is destroying the dollar. I think the current policy, both monetary and fiscal, meaning government policy, it is destroying the global economy. They're not destroying the dollar. The dollar is rising relative to other currencies. They're not destroying the dollar. They're destroying the financial structures, and they're destroying the global economy. This is very important. I made a forecast 2 years ago, kind of a paradoxical forecast. It's coming to pass. It's a very strange forecast. It called for the dollar to rise, then rise some more, and finally vanish. It will vanish after it has killed almost all the other foreign currencies. I'm familiar with some of the minor currencies like the Dominican peso. It's down 30% in the last 3 years. Look what happened to the Canadian dollar. It's down 30% in the last 3 or 4 years. Look at all the different all the secondary currencies. Let's leave out Venezuela for the moment. Brazil's currency is down something like 40 to 50%. Look at all the other currencies in the middle tier and you see vast destruction. Okay, so the current policy is not wrecking the dollar. It's lifting the dollar, but lifting it relative to what? The other currencies. You can see the British pound has fallen in value. They're not destroying the dollar. They're destroying all the other currencies and the financial structures. They're destroying the integrity of sovereign bonds, namely, which means national government bonds like the Italian government bond. They're destroying them all. Quantitative easing is the monetary policy from the Federal Reserve and from the European Central Bank. They're buying government debt. If you take a look at the Italian government bond from, say, 5 years ago, it had a rather high interest rate, over 5%. Right now it has an interest rate, a yield, less than the Treasury bond for the United States. It's because they destroyed the integrity of the sovereign bond market by printing money to buy the bond. So what you have is the European Central Bank and the U.S. Fed. I call it U.S. Fed because it sits on the United States soil. What you have is that they're buying the government debt from various major nations in order to prevent the biggest banks from failing. They're not doing it as stimulus. That's what they call it, fiscal stimulus, monetary stimulus. There's no stimulus there. They're just buying up toxic bonds. Here's a little simple formula for you. Okay, you know what insolvency is. It means your assets aren't worth as much as your debts. And you know what liquidity is. That's just the flow of money into the system, cash flow or investment flow or whatever. Okay, so the formula I have that I like to recite is that if you have insolvency for a financial firm like a big bank, and you compound the problem with lack of liquidity, you get a bank failure. So when Lehman hit, lots and lots of banks suddenly found themselves insolvent. Shortly afterwards, the central banks decided to print money and buy up toxic bonds. In other words, provide liquidity for the insolvent banks so that they would not enter failure. Is this simple or what?
Mm-hmm.
It's very simple. Okay, they're not destroying the dollar. They're destroying everything except the dollar. All the financial structures. That's why you're seeing the Asians and Chinese and Russians support the non-dollar platforms, like the Chinese interbank payment system that competes with the SWIFT.
The SWIFT system you're referring to, correct?
Chips, yes. It competes with the SWIFT with international bank-to-bank payments in big transactions. You also see the rise of the BRICS Development Bank, which I think has got a very false name. I'm not sure that there are any development projects that they've announced yet. So I reason that the BRICS Development Bank is really going to be a processing center for all the major Western sovereign bonds to convert to gold. I think the BRICS Development Fund is their central bank for gold, because they've also got the Asian Infrastructure Investment Bank, AIIB. Well, that's for the development. There's no development in the development fund. There's plenty of development in the AIIB. So you have the rise of lots of these, of different anti-dollar, non-dollar platforms, and they're getting volume. They're getting big volume, and it's not being reported by the Western press, the British, European, and U.S. press. It's not reported. Huge volume. So the policy, here's a great concluding point, Mike. When they do QE, it is the absolute opposite. This bond monetization, the bond purchase plan, it is the exact opposite of stimulus, because listen to this sequence of factors. They print extra money in hyperinflation style, and the investment community within all the nations hedges against the hyperinflation by investing in hard tangible assets, which raises the cost structure, which reduces the profitability for companies, which lay off people and close down business segments. So it kills capital. They retire the machinery, they shut down the factory, plant and equipment shuts down, liquidated are the machines and the telecom systems, and you get all these different liquidation sales of pretty valuable assets. Okay, that's the result of QE. That's not stimulus. It's capital destruction in a sequence. So, why are they doing QE? Go back to the point I made. To provide liquidity for insolvent banks in order to avoid their bankruptcy.
So question, if the QE ultimately continues to move in the direction towards hyperinflation, then that would tell me that there would be a rapid, sooner or later, decrease in the dollar. Are you suggesting that that's coming? Or, because what we're seeing, of course, is the dollar continues to strengthen, and I would guess that that is largely a result of muscle memory, for lack of a better word. People are so used to flowing into the dollar when times are bad. Is that what you would credit that towards, or how are the two coexist?
It's more the destruction of the competitive currencies. Take, for instance, Brazil. Can they print a lot of money to cover their deficit?
No, so we're talking largely about like emerging market issues then, with like repayment of the dollar?
I'm just giving one example. Can Italy print a lot of money to cover their deficit?
No.
No, but the European Central Bank can. Okay,
Yes.
So Italy has an advantage in that respect with the euro. Brazil cannot. Other countries are left with rather significant deficits and the inability to finance them. So what happens to, say, well-heeled, wealthy people in Brazil? I like Brazil as an example. It's a very good one. The very wealthy people in Brazil abandon their own country's currency and they buy treasury bills and dollars. That's the phenomenon. Now you say that we've got this hyperinflation, it's going to bring about a reduced dollar. I'm saying rather emphatically, it is the exact opposite, Mike. We're printing dollars to cover our deficits while competitors cannot do the same with respect to their currencies, and therefore we're killing the other currencies. Killing them slowly with QE, and their countries are investing in the dollar. We're not killing the dollar. We're lifting the dollar. But when we're done killing off the financial structure of the world and enough other competitive currencies, the dollar's going to vanish. Remember I said this 2 years ago.
I do.
The dollar's going to rise, then rise some more, and vanish to be replaced by the gold standard. We're not there yet. We have more destruction to do, Mike. We're not done. How's the Italian banking system doing?
Not so good.
Why aren't they doing much better if all this money is sloshing around? The Euro Central Bank is buying up the Italian government debt. Why isn't that helping Italy? This is a key question. Shouldn't that be helping the Italian economy? No! They're buying government debt when no one wants it. They're providing liquidity for the big banks in Italy that own Italian government debt that no one else is willing to buy. That does not help the economy.
Sure.
Hyperinflation is covering sovereign bonds and not much else. There's talk now the European Central Bank wants to buy corporate bonds. Why? Because they've killed the economy and no one now wants to buy the corporate bonds. Whatever they buy, they kill. Does that make sense?
It does. It does.
Everything they invest in, they kill. Hyperinflation kills whatever is directed for those funds. If they decided that they were going to direct all the new money into automobiles, then they'd wreck the car industry. But they decided they're going to pump it into the big banks, and they didn't support the big bank. They supported the government debt, the sovereign debt of U.S. Treasury bonds. And therefore they helped out the Wall Street banks that own gargantuan sums of Treasury bonds. Now, we have a new problem. I said that they destroy everything they invest in with the hyperinflation. They have now destroyed the U.S. Treasury bond market. Its integrity is totally wrecked. Well, gee, Jim, well, why can't I see it in the Treasury bond yield? Because they're not done. We got integrity problems right now. Okay, here's another basic question. We saw QE come in around 2012. I actually forecasted it a year in advance. And regarding the 0%, I forecasted that a year in advance. Of course, I was called stupid. And of course, it turned out to be correct. And of course, all the people who called me stupid told me later, well, it was obvious. Okay, that's the sequence of stupidity with respect to dumbasses listening to forecasts. You're an idiot for making it, then when it happened, it was obvious. Everybody knew it. Oh, really? Not you, not your father, not your friend, not your brother, not your neighbor. I was kind of alone with maybe, half a dozen other sharper analysts. We expected it to happen. Okay, when the QE began, it was brought on, Mike, for one very big reason in addition to bailing out the insolvent U.S. banks that would have gone bankrupt without the extreme liquidity all of a sudden. They had to make up for the absent buyers of Treasury bonds. The auctions were taking place, and it became very clear that foreign countries, foreign central banks, were not interested in buying our Treasury bonds because of the subprime mortgage issue and the immediate impact of the major, ugly recession. Okay, so when they started QE, they had to react to this major problem of an absence of legitimate Treasury bond buyers. You cannot have, at the time it was something like a 3% Treasury bond. You cannot continue that without buyers. And with the big problem with Lehman and the recession that immediately began then and has not stopped since, we have 8 consecutive years of recession. I know that's difficult for people to hear, But they need to understand that there is no sluggish recovery. Sluggish recovery is kind of a fascist manifesto dictum. You can't talk about the recession. If you do, we'll put you out of business. We'll blackball you. So call it a sluggish recession. A sluggish recovery. There is no recovery. Every year we're suffering between a 3 and a 6% recession. Every year since Lehman. Let me repeat that. We've got right now something like a 4-5% recession this year. Every year since Lehman, we've had a 4 or 5% recession. Every single year. What they're doing is they're lying about price inflation, and they're calling inflation growth. I don't want to get into a lot of details for that, but the point is they lost the legitimate buyers to the Treasury bonds. So they had to do something in an emergency. They had already gone down to near 0%. So what they did was they said, we're going to cover with quantitative easing, which is a nice way of saying Zimbabwe-style monetary hyperinflation. We're going to monetize the debt. And they did so using a major tool called the interest rate swap derivative. And this is roughly how it works. They get free money. Now, never forget that on the low end, you've got 0% money. Never forget that the feeder system for the Treasury bonds in their interest rate swap derivative machinery, the feeder system is free money. So they use the coupon versus the bond market, the coupon versus cash market with the short end, and they play off with arbitrage the long end, the 10-year, and what they do is they use the differential, and with the free money, into the system goes all this money that doesn't cost them anything, and on the other side is fabricated demand for the Treasury bond. And the big smoking gun was evident in the second half of 2009 and the first half of 2010 by looking at the OCC, Office of the Comptroller and the Currency. Morgan Stanley added about $60 trillion worth of interest rate swap derivatives. At the same time, we were told that there was a massive bond rally as investors flocked into the safe haven of Treasury bonds. It was one of the biggest lies ever told in the history of the United States finance. What they did was they started up the interest rate swap derivative machinery and put on $60 trillion worth of activity that resulted in a massive, massive Treasury bond rally and a dropping of the bond yield. So that's what QE is all about, preventing big banks from going bankrupt and providing the demand from artificial means for Treasury bonds.
That brings me to an interesting question. Do you think that the manipulation of the gold market and the precious metals market with paper, meaning, for instance, paper gold, do you think that has had something to do with the buoying up of the dollar as well?
Yeah, well, there's a negative correlation between gold and the dollar. The dollar's gone up and the paper gold price has gone down. I never like to call the paper gold price the gold price because it's not. I mean, suppose you went to a big dealership and you wanted to buy a Mercedes and you laid down $60,000 and you said, I want to pick up my Mercedes in 1 month. And they say, okay, very good. And you come by in 1 month and you say, I want the keys to my Mercedes. And they said, no, we don't have a Mercedes for you, but we will let you buy 1 month later the same Mercedes. We'll let you roll over that contract to buy a Mercedes. How would you react to that?
I don't think they want to be there when I react to that.
Okay, well, you'd want to urinate on their leg.
I think that's putting it mildly, but okay.
Well, you want to shit in their hand.
There you go.
I'd shit on their desk and then piss all over their legs. Okay, this is how the gold market works. Therefore, the gold market, as we know it, is not a gold market. It's a paper gold market. They sell paper gold. They can sell, and they have in the past, many different occasions, sold, say, 3 months of global mine output worth on paper, and done so in less than a single day, and not delivered any of that gold that they sold. So why would I care about the COMEX gold price? I don't care at all. I don't give a rat's ass. I don't give a backward flying dried rat turd about the COMEX gold price. Because let me tell you some facts that I know from contacts of mine, colleagues and friends of colleagues of mine. That just qualifies the nature of the source. There are places like Hong Kong, like Dubai, and like Indonesia, where rather substantial purchases are made of gold bars. I've seen pictures, I've heard figures, I've seen details of transactions. If you want to buy, this is one example, just one example. It was a big bin that contained somewhere between 100 and 120 bars. Each bar was 10 kilograms, rather substantial size. And the price for that entire bin was $2,100 per ounce of gold. This was a month ago. If a major purchase of a few hundred bars of gold was at $2,100 an ounce, I ask you, what is the price of gold?
I think right now it's somewhere around $11.50, give or take a couple dollars.
No. It's around $2,100.
I'm sorry, paper gold.
I just gave you an example.
Paper gold.
You gave me the price of paper gold.
Exactly.
I don't give a backward, flying, dried rat turd.
And your point is the
about
giant
the
difference.
Paper gold price.
Your point is the giant difference between the two is indicative of the amount of fraud that's taking place.
Exactly. The physical gold price has roughly a 100, call it 80 to 100% price premium over the listed COMEX paper gold price.
Mm-hmm.
I do not call it the gold price. I call it the paper gold price. Okay, The Voice has told me something. The Voice is an international gold trader, among other things. The Voice told me back around Thanksgiving that there have been numerous transactions over $100 million for gold. The price is roughly $2,500 an ounce. So I ask you, if for around 100 million or a little bit less than 100 million, the price is 2,100 in various locations, and for over 100 million, the price is 2,500, I ask you, what is the price of gold per ounce? And please don't quote me, please do not quote me the COMEX price.
No, it's the latter of the two. It's the 2,000 plus, whatever that number was.
It's between $2,000 and $2,500 an ounce.
So what a person's willing to pay for the actual physical gold is the actual price, not whatever the paper listing is.
Exactly. So what importance is the paper gold price from the COMEX? What significance does it carry?
The only significance I can think of is that it's being used again as a means to boost the dollar.
It's a distraction, Mike.
Yeah. Two ways of saying. Two ways of saying.
Consistent with your point. Yeah, consistent with your point. It's a distraction. Okay, I have clients who say to me, but wait a minute, I can go to my dealer and I can buy 4 coins and pay $11.80 per ounce. And I say to them, fine. Does that fool you into thinking the price of gold is $11.80? How about if you go to that guy and say, I want to buy just $2 million worth of gold coins at that price? What's the reaction from the dealer?
I wish I had an answer. I wish I had done that, but probably not.
We don't have it.
Right. There's not enough supply for them to do that at that price.
Why is there not enough supply at that price?
Because there's over 100 times more paper gold that just gets invented out of thin air by these central bankers that's traded.
Yeah, I think the actual ratio is something like 45. Maybe it's 60 now. I'm not sure. But let's just say 40 to 70 claims for every ounce of physical gold. Okay, I have a way of interpreting this. The powers that be make sure that the nickel and dime buyers always have a little bit of supply available to them for buying their 3 coins. That way, they're lulled into thinking that the price of gold is still $11.80. Try buying $2 million worth and tell them that you've got the car out back with the money and 3 armed guards holding it, and you'll get the same answer from the dealer. We don't have that amount of supply. So what's the price of gold? It's not
21.
Right.
What that number?
2,100 to 2,500. It's not the COMEX price. Okay, I'm tired of hearing people tell me, but that's the COMEX price. It's the only price you have available. No, it's the only price you know about that you have access to. Because you don't have enough money to buy it. Because you don't have the ample cash. The voice made a very good comment, very important comment last week. He said, you guys are overlooking something. The gold is there. You must have cash. A lot of it. So cash buys real gold, and you got to pay over $2,000 for it.
So help me transition this to something that would help the common everyday American understand the danger of what lies on the horizon. Let's say perhaps somebody who has been investing in silver, and we've seen the price of silver recently drop, or how these price manipulations are ultimately going to come back to bite them, because the overall sentiment around the country is that regardless of our levels of debt, regardless of most people don't understand how the Fed being the buyer of last resorts, ultimately it does affect them. So what would you say to try to connect some of these dots to let the average American realize that that it is not a new day dawning and everything's going to be okay, that it is absolutely a time to be hoarding Band-Aids, bullets, and beans, so to speak, because it is not a new day dawning. Things are going to be very rough in the near future.
It's very difficult to open the eyes of people who don't have much intellectual capacity. And I don't like to sound like an arrogant ass, but you cannot teach a dog Spanish. Okay? This is not easy stuff. When people are operating inside the United States, they're subjected to the American mass media. And to be sure, they might get a little bit of alternative news. But what I've noticed about most Americans is that they don't understand the dollar. So how can they understand a problem for the dollar if they don't know what the dollar is? Now, it sounds a bit snooty, but let me give you some details. If you ask a typical American, do you think QE and supporting our government debt with printed money causes a problem? They'll probably say, I didn't know we were doing that. But if we are, it seems to be working out very well. You can't teach a dog Spanish, Mike. If I ask a typical American, what is the role of the dollar in international commerce, you're likely to get a question about the Boston Red Sox in return. Again, you cannot teach a dog Spanish. Okay, I have this precise point addressed in the December hat-trick letter. Let me just read it to you because I think it's very relevant, and it only has a 1-minute preamble. Can I proceed?
By all means.
Okay. This is me talking. It's a quote by me in my quote section for the hat-trick letter. I have let go many, many people in the last several years. I share your frustrations in dealing with family and friends, trying to convince them that our U.S. nation and financial system are in tatters, with the collapse well along in progress. They all have great difficulty in accepting the reality of deeply entrenched problems. They are stuck in a strange refusal to believe that all is not as it seems. Their assumptions run deep and wide, while almost all are very wrong. Ask these people some hard, probing questions which reveal the broken nature of the entire foundation and platforms. You will probably get blank stares and non-responses from the following 7 questions. Number 1, do you think the now nearly $20 trillion federal deficit will cause problems? Number 2, do you think 5 years of 0% money and African-style monetary inflation with bond purchases to cover the U.S. deficits will cause problems? Number 3, do you think endless war, like in Ukraine and Syria, to defend the U.S. dollar system will cause a backfire and problems? Number 4, do you think the $550 billion annual trade deficit for the United States will cause a problem? Number 5, do you think the real 23 to 24% unemployment rate will cause a problem? Number 6, do you even know what the global currency reserve means in its definition? 7, do you even see that there are no fair financial markets anymore and that all the major ones are rigged? Okay, those are the 7 questions, Mike, and here's my little conclusion afterwards. Ask the questions and then just walk away. It's best to put these 7 points on paper and hand it to them. These questions will very likely draw blank stare responses out of sheer ignorance, perhaps just denial and stunned silence, even apathy and indifference against a backdrop of national systemic failure. So many people are being misled and being deceived. So many institutions are complicit in the Graham collusion, led by politicians, economists, and the news networks. Not to mention the Hollywood productions in order to fortify the false stories. See the movies like the false Obama bin Laden death. What was that called? Zero Dark 30? See the Deepwater Horizon collapse false movie story. See the upcoming Boston Marathon explosion false movie. So Hollywood is on board here. So many people seem to prefer the delusions so as to stay comfortable in their framework of false security. So many people are beyond edification and hopelessly scratching from one week to another, unaware and unconcerned about the fate of the nation. Such is the nation of our country. Best to tend to our own gardens, our own closest loved ones, and leave the others behind to fend for themselves. Best to just walk away. Let it sink in. Invest in your own future with gold and silver and walk away from your paper investments with stocks and bonds. It will never sink in to most people unless and until those people's bank accounts are stolen And those people's supermarkets have empty shelves. And they have to fight the riots to return safely to their homes. They might never wake up. That's the end of my little speech. Did that address some of your major points, Mike?
I think that addresses almost all of them. I did get that letter, and for everybody who's listening, I certainly am a subscriber to the Hat Trick letter, and I would recommend it to absolutely anybody because it does include all of the interviews that Jim does in a month, and you just hit on virtually everything. One of the questions that I get from people so often is, how am I, everything that you're saying, how am I going to feel that in my everyday life? And one person even broke it down a little further, saying, I didn't notice any difference between 17 trillion in debt and 20 trillion. So why would I expect that I'm going to feel a difference with the things that you're talking about? And one of them I think you hit on was, when you ask somebody, do you even understand what it means to be the global reserve currency? Anybody under the age of 70, roughly, has never known the planet to not have that dollar as the reserve currency, so they don't comprehend, partially because it's not taught, what losing that status is going to mean. That is when they would begin to feel that pain, that those empty food shelves that you're talking about, that huge trade deficit, all those things would come into play, and people wouldn't just feel pain, they'd feel more pain than most could bear. And that's, I think, one of those giant disconnects. Do you have any thoughts on if or when we might lose the reserve currency? One of the things but before I pause for a second, one of the things I try to explain to people is, that's not going to be a big vote that's going to take place on the UN floor someday. All in favor of changing reserves, aye. It's a process, and it's one that's well underway, has been well underway. And, if you take out some of our major trading partners, how many people are still left using the dollar before we lose that status, whether we want to or not?
Okay, I have an answer. Been taking a few notes, and these are great points that you make, Mike. And let me follow up and support them. I'm 64 and a half years old. It's kind of funny. I get people write me on my Contact Us, and they say, Jim, you don't sound 64 years old. And, here's how maybe a 64-year-old man might sound if he doesn't have a lot of energy and vibrancy. But I do, and I sound younger. Okay, I was a Vietnam high school kid, okay? I was scared shitless of going into the meat grinder at age 18 in 1969. I was relieved beyond description and words when Nixon decided that the war had to be ended in 71. I went through the second draft lottery in 1970 in Pennsylvania. I got through it. They did not get to my number. The reason I bring up Vietnam was that Vietnam was the cause for the first $1 trillion in the U.S. government deficit. I'm going to get to your question. How does it get there? The first trillion was an enormous controversy. My father even talked to me about it. I was, around 19, 20 years old. And he said, Jim, this really, really bothers me. With this kind of debt, our country is going to have some severe problems. Okay, so here's the irony. The first trillion is a nightmare problem. But when it goes from 19 to 20, it's no big deal. That's ridiculous. Okay, here's another point along this same line. I remember it was like yesterday. We were roughly at 17 or 17 and a half trillion in the U.S. government deficit, and there were battles on the congressional floors for raising the debt ceiling. Do you remember year after year we had to raise the debt ceiling in order to accommodate more deficits?
I do.
Do you remember that?
I do.
Okay.
I believe that fight is coming again here very shortly.
No, it's not. No, it's not. Because in 2013 and 2014, they decided no longer to deal with it. There's no raising the debt limit anymore because we permanently made it irrelevant. There's no debate on raising a limit because there is no more limit since 2013. We don't debate it anymore. We just go ahead and have more deficits. I made a forecast in 2009 following Lehman that we would not have an economic recovery following the Lehman incident, and we would not avoid trillion-dollar deficits for as far as the eye could see. I said this in the spring of 2009. How did that forecast work out, Mike?
Dead on?
Dead on. In fact, we've got a new phenomenon. I'm going to get to your question about the dollar breakdown. I'm going to get to that. I've got my notes right in front of me. Okay, we moved forward with this breakdown, and it became very ugly. We had to cover the deficit, even though we went to the next year's deficit without a limit. And I believe what happened was around 2014 we had a debt default. Okay? But in the meantime, we're doing something rather dastardly about the deficit. Now, let me give you an example of some of my background. In the second to the last corporate job that I held, I was at Staples headquarters, the office superstore supply company. I was at Staples headquarters in West Boston suburbs, 2,500 people at the headquarters. It was a fun place to work, a growing business, and I was in charge of seasonal adjustments. So, you have the Easter vacation drop down. You have the early summer vacation, June, July, July 4th vacation, the drop down. You have the big back-to-school climb. You have the big Christmas season climb. Okay, that is the definition. I'm describing the seasonality for the Staples business. Okay. The main characteristic of seasonal adjustment is that it's within a single year. Okay? So the next year comes and you expect the same lull at Easter. You expect the same drop down in late June and July from school being released. You expect the big build-up at back to school and the big build-up at Christmas. You expect it. You build it into your forecast models. And that's what we did. Every 3 years, I was there for about almost 6. Every 3 years, we would change the coefficients in order to reflect better the last 3-year period. What the U.S. government has done in the last 2 or 3 years is to alter their seasonal adjustment every single month. What they're doing is they come up with a result and they make some adjustments to their coefficients that coincide with their desired result. It's absolute heresy in the statistical forecasting and reporting business. Then they compounded their errors and their fallacy and heresy by telling us, for instance, that the fiscal 2014 year had an adjusted $590 billion annual deficit for the U.S. government. And I looked into the adjustments, and I found nothing but nonsense. You don't do an adjustment on a full year. If you do, then what are you doing? You have an adjustment for a few aircraft carriers that were large items? No, it's absolute nonsense. You do not do adjustments on a full year of reporting. So I called the $590 billion pure rubbish for 2014, and later we came to learn that it was a little over 1.0 trillion, in keeping with my forecast of 2009 of $1 trillion deficit for as far as the eye can see. The deficit for last year was $1.4 trillion. We're actually on course this year for somewhere around 2.0 trillion for the current fiscal year U.S. government deficit. Unbelievable what we're doing with respect to the deficit. So the first trillion is more important than the most recent. There is no more debt limit. There's no more debate on the debt limit because they want you not to think about it. We've got the debt covered, and I believe the Chinese forced a default 2 years ago in the government deficit, and the government debt, when they purchased J.P. Morgan's big headquarters center, complete with conference centers, and the Fed's vault. They purchased it for a ridiculously low price, and I reason that it was part of a complex deal with some derivative failures tied with income tax, securitized aggregate bonds. Now, if you have a recession every single year, you have less income tax revenue. So I believe that some sort of aggregate bond on IRS income from that secure stream was promised to the Chinese, and we defaulted on it as a result of a multi-year recession, permitting China to buy $1